Vikash Jain joins us now. Let's take a conversation forward. Let's understand where he is, where he feels that things are headed. So, Vikas, fantastic to have you back. Thank you for joining us. Lot of moving parts this Wednesday morning. Lot of moving parts literally. One side, crude is on a boil. US bond yields are spiking, and we are 10 trading sessions away from the budget. What do you want to start with?
I mean, let's start with the setup for the year. A lot of what you're saying is something which was clearly going to be the important themes for the year. That is rising bond yields, as well as relatively strong commodity prices. So if I were to look at this year itself, and we came out with our India themes report, which had about 30 themes to talk about, 16 of them macro and strategy themes. The three big ones to discuss right now for us in India would be firstly the global macro. If we look at policy rates increasing for central banks, particularly the likes of Fed, and even our economist also believes that India will have almost 100 basis points hike during FY23. We look at previous such cycles. In the last 20 years, there have been two such cycles for the Fed. And the first 50 bips increase and the first 100 bips increase. Who are the ones which have come out as winners and losers? And it's pretty clear that if you were to look at the US banks have clearly outperformed NASDAQ as well as the S&P 500. So even when we started the year, this was likely to be the most important global market theme. And in this setup, banks typically end up doing well and better than the technology names. The other thing which is obvious, which is the other discussion point, is when yields start rising, very expensive growth names take a back seat in favor of value. So this theme means value should do well, banks should do well, and IT in general should take a back seat, and expensive growth should take a back seat. The second one, which is of relevance for this year, is the opinion of our global strategists that China recovery should start taking place this year. The obvious thing which happens when that happens is commodities should do well. And in a way, what you're seeing in crude is part of that, other than its own supply demand, where I think supply is really tight for crude. So commodities doing well should be good for commodity names like metal names and also crude names. But the other lateral thing which we believe will happen if China starts doing well, last year, China, with all the worries around China tech did really badly, and Indian IT outperformed China tech in a big way. If you were to look at China tech has all the e-commerce names and all the growth names which are there, as compared to Indian IT, which is from that perspective a relatively old style IT services kind of basket. Despite that, Indian IT is right now at a 50% premium to China tech. Historical average is about a 20% discount. As appetite for China improves through the year, I think laterally, what doesn't come out obvious but could happen is Indian IT could be, a little bit of a loser on a relative basis. So both of those themes are not good for IT. One is good for banks, the other is good for commodities. And finally, closer home, if you were to look at consumer confidence measured by RBI themselves, this is at its lowest in the last 6-7 years, broadly, except the brief months around the pandemic lows. So if I were to compare it versus 10-year averages and look at the top 15 economies, India is right now at the worst consumer confidence level, other than Thailand. So that makes us wary of taking big consumption bets. So the setup for us is positive on banks, positive on commodities, and a little bit of a worry around IT on a relative basis, and trying to stay away from consumption in general. That's essential. And value from that perspective also, if you were to think about it from a bottom-up basis, which are the most expensive names on Nifty? It's IT names, it's consumer discretionary names, which are the cheapest names. It's banks and commodities. So even from a bottom-up basis, that fits well for our, to start the year with.
It's a great point. So let me be the devil's advocate and throw in IT. IT is a growing sector. So far, they've not felt any pinch of the margin. And will it be a good idea to compare India and China, at least when it comes to tech? Because the tech stocks which are under your coverage, those are very different companies. They generate a lot of cash, they are growing, and they're doing buybacks.
Sure. So, I mean, the way to look at it is over a longer period, except for right now when there is, because of the pandemic, there's clearly IT spends which have gone up. Some of those, not just China tech, but otherwise tech in general would, and here I'm comparing it versus BSC IT, which is primarily IT services. China tech would have perhaps more growth oriented names. And these are relatively, unlike a lot of the tech names which have got listed in India, these are reasonably profitable and large names. So from that perspective, I would say that the longer term average of a 20% discount that Indian IT trades versus China tech is perhaps the right one as compared to the current 50% premium. So if you look at that, I would say that some kind of mean reversion could be par for course if appetite towards China improves during this year.
Because why do you like banks? And A, banks are already an overweight position for institutional investors because of benchmarking factors. And B, some would argue that this time, hey, the credit cycle is different. Last credit cycle was built on power, it was built on cement, it was built on steel. This time, companies may not go to banks to draw a lot of credit.
Sure. So, fair question. When we look at positioning, I think what we need to look at, where is positioning versus history? And that's where the problem comes in for when you were to compare these two big sectors. Banks are, on an absolute basis, the bank index is near its historical average valuations at a time when the market is near +2 standard deviation of its historical average valuations. On a relative basis to Nifty, obviously it's at -1 standard deviation. And FIIs have never been so less underweight in the last so less overweight on banks in the last 6-7 years. A part of that overweight is compulsion because a couple of large names are not there in the index. However, on the other hand, if you were to look at IT, the underweight in IT, both for FIIs and DIIs, have never been so less. So essentially, relative ownership of IT has improved by leaps and bounds through this period when FIIs were actually selling. So what they were doing is, on a net basis, they may not have been buying India. In fact, they were selling India over the last 6-8 months, but they were clearly selling more of banks and shifting into IT. And if you look at IT valuations, those are at +3 standard deviation versus historical average levels. And even relative premium is at +3 standard deviation at a time when Nifty itself is at +2 standard deviation. So IT looks overvalued versus history, over-owned versus history. Banks look, not expensive versus history at all, and under-owned versus history. They are overweight, all right, but a part of that, like you rightly said, is because of compulsions. But FIs have never been so low overweight on banks in the last 7 years.
Good morning, Vikash. It's Nara. On a lighter note, I see you're still a Virat Kohli fanboy. Years ago, you got that makeover in honor of the Indian skipper, but now he's, of course, no longer the captain. But back to the serious stuff. You talked about IT, you've talked about banks. I know you track crude oil very closely, you track oil and gas very closely as well. But just the way Brent is going up, what's going to be the impact of this on markets, and what will the CLSA India strategy be with the oil and gas related stocks, and of course the new buzzword as far as renewables go?
So, see, if you look at history, crude going up is generally an indication of a risk-on sentiment globally. Okay, generally. And although it might sound odd, but typically when crude is going up because of demand also picking up, then Indian markets have done very well along with that during that period. Also, if you compare where we are versus say 10-12 years back, the thing is, crude is no more that big a problem for fiscal deficit because subsidies are clearly out of the window now. So that big worry is gone. Yes, there is a current account worry, but to our understanding, RBI's current forex surplus is to a level where it can easily fight any big speculation attack on the rupee. So from that perspective, crude going up per se, yes, it's an inflation worry, which is more a worry like it is in any other consuming nation in the world. But it's much less of a worry than what it was, say, 10-12 years back for the government accounts and the country's finances. So that's how I think about crude. Generally, crudes, if you were to look at the years of underinvestment in this industry and now a clear focus on not really spending so much on or not allowing so much spend on hydrocarbons, that will have its repercussions, in my opinion. I think that day, this is perhaps sometime in 18, 24 months. This year, a lot of the consuming nations could blame the OPEC, saying that OPEC is underproducing and that's why crude prices are higher. But as demand normalizes to 2019 levels and then perhaps go up even higher than that, maybe in 12 to 24 months' time, we could hit a point. That point is not far away when Russia, Saudi Arabia, and the US are all producing at record levels, but still there is supply concerns that are there in the world because of the underinvestment that has happened. So, we could get to a period which is, crude going closer to, the 3-figure mark and everybody producing at near high levels. OPEC spare capacity is already down to just 3.5 million barrels per day, even before we get to normalize demand to the levels of 2019. So the underinvestment, or as they call greenflation, is also a theme for many of these old commodities, which could be real over the next 2 to 3 years. So that's something that we need to bear in the back of our minds.
Okay, so let's see with India being in a stronger position, that the old trend that we used to see of the Indian equity markets going up, however surprising it would be when crude oil prices go or not, happens this time round as well. Vikash, you've talked, like I said, about IT, you've talked about banks, you don't want to talk about consumption. Now, this mega trend of going green, ESG, you've talked about the inflationary impact. But then, one of the most suited players for this is considered to be Tata Motors with its EV play. But CLSA, traditionally a Tata Motors bull, recently went bearish. It put a sell on the stock as well. What's the larger play? What's the larger thinking that you folks have?
Let's not be stock specific. Yes, we've made some portfolio changes recently. But clearly, I think the point to make over there is that we are still thinking which of these players will be in a strong footing as the industry actually gets disrupted. So that's a debate which will continue. In fact, that's something but in a way, our opinion on certain stocks can also depend on stock specific events. So I'll not want to comment on that. But we are still trying to think aloud on which of the traditional names would be able to do well despite the disruption. However, what we need to bear in mind, in general, some of the subsectors like two-wheelers, it will be very difficult for the market to make up its mind very soon on who the winners will be as this disruption is playing out. So there could be an overhang on many of these names. So the broad thought process is to stay away from disruption or subsectors where there are bigger disruption worries which are there. So if you were to look at our stock picks, there are very few of them which are really getting impacted by big disruption broadly. So that's how we are thinking about it right now, to stay away, because I don't think market will be able to make up its mind on the winners of this disruption as soon as the next few months. That's the debate which will continue. And an overhang at different order for different sectors and different subsectors will continue through the year.
Sure. Vikash, in one of your recent notes, you've mentioned that you foresee banks as well as Reliance Industries slated to drive year-on-year growth in market earnings in FY23. Where within Reliance do you believe the bigger disruption is happening? Because what one can see is it's pretty much across the board, be it what they're doing with Geo, be it the kind of expansion mode that they're in, and of course their recent expansion into the green energy vertical as well. And does that also somewhere make the case only stronger for the big to get bigger and better in the years to come?
I would not like to be stock specific, but clearly it's one of the few conglomerates which doesn't really get impacted by disruption. If anything, it could be the beneficiary because it is there in all the themes over there. So over the longer term, clearly, If you look at most of the important themes which are playing out, whether it is technology, e-commerce, organized retailing, green energy, as well as greenflation to some extent, it could be a beneficiary of that broadly. So that's on that stock. On your earnings growth bit, if you were to look at simple near-term earnings growth, that is incremental profits of FY, the growth of FY23 over FY22, the incremental profit growth, there are about 10 names which make up only about 1/3 of Nifty weight, which contribute 80% of that incremental profit growth. And that's constituted by some of these banks, about a couple of these large names that you mentioned, and also some commodity names. In fact, 5 of those 10 names feature in our focus portfolio. So we have a focus portfolio where we look at about 12 stocks, which makes up about 3 banks, 3 commodity names. So it's a very clear preference of being overweight banks and overweight commodities. It's very clearly underweight IT and very clearly underweight consumption. Again, brings us back to the themes that we discussed at the start of the interview.
Yeah, I get that. Wanted to understand what is it that you're making of what's happening within the Indian pharmaceutical space. And I'm going to include healthcare services here as well. Because, as sensitive as healthcare services particularly would be to, the COVID numbers back here in India, pharmaceuticals has somewhat, sort of taken a backseat. They're no more the creme de la creme space that they were and that sought after all through 2020, for instance.
So clearly there's an element of sector rotation which is playing out. If you remember, these were the stocks which were doing very well at the start of COVID, seeing as big beneficiaries of COVID. Some of them went up in hopes of, COVID, perhaps COVID remedies, COVID vaccines, that could be big beneficiary from them. Sometimes when there is so much excitement, stocks run ahead of themselves and there is a period of consolidation. We believe that, perhaps we are towards the fag end of that consolidation for some of the pharma names. And we have one of the pharma names and we are through that overweight in our positioning in pharma. So we like, if you were to look at defensives, IT, pharma, and consumer staples, amongst them, and utilities, maybe utilities and pharma is what we like much more than the other two. So, and we should not forget that we are starting the year when there are things which are not on our side. It's not an unequivocal year where you can say, bang the table about what's going to happen. It's a year where, there'll be a balancing act. There are, right now, the big worry is the absolute valuation of Nifty, both on an absolute and a relative basis. We are at levels where, historically has not given us great returns, and consumption sentiment not being that great. Those are the two big risks when we start the year. The balancing factor is, if you were to look at earnings growth, Nifty is the best earnings growth story amongst large markets in the world, other than Philippines, which is not that big a market. So that should in a way offset some of that valuation worry. So there will be a period when defensives will get relevant, because it's going to be a year of big sector rotation and not really a runaway move on the benchmark. And if you were to look at defensives, pharma would be amongst the preferred ones for us.
You have a contra call in real estate. Your team has made a case, if I go through a presentation, that interest rates will go higher, which they will, but they will start impacting affordability. Will real estate market be sensitive to a 50 or a 75 bips rate hike? Do you think that will change the affordability factor and the uptrend in real estate cycle?
So I think the call is more to do with where expectations have run up to. Essentially looking at the kind of registration data, etc., that we saw last year, which was also boosted by state tax benefits which were given. So it's more to do, that the call is more to be selective on certain names where we see clear consolidation benefit and new launches or new markets helping them, and rather than a call that the cycle will. We are definitely, we don't believe that we are in a booming real estate cycle which will pick up in a dramatic manner. But yes, I mean, both real estate and capex in general, it's going to be a gradual recovery that we favor. So that's our thought process. And sometimes, like I was talking about pharma, some of these names can run ahead of themselves, and that's where we see periods of consolidation. It's really to do with that call, rather than saying that the cycle will turn, prematurely. So that's not what we are saying. What we are saying is that maybe expectations have run ahead, and that's why we are a bit more choosy in real estate than many of the other peers on the street. Clearly, rising. I understand what you're saying from a perspective of affordability, but some of these interest rate sensitives can take a back seat during the period when rate hikes are happening and yields are rising. Because more so now, when clearly there is a linkage to repo rates that housing loans have. So there could be more of a stock reaction rather than the business slowdown per se is what we are talking about.
Because just to wrap it up with one final question, we normally start our interactions with a view on liquidity. But can we say that we should not really worry about a lot of liquidity withdrawal or liquidity contraction? Because 2022 was not like a year where FI liquidity really dominated. It was more domestic liquidity which made all the difference. That was the back support on which markets were able to digest the FI. So while money may have come in the IPO market, it may have come in the startup market for secondary liquidity, the FI liquidity was not humongous, so we should not worry about it.
Well, that's right. I mean, but I'll tell you why we cannot ignore it. So if I were to look at the last 6 months, on a rolling 6-month basis, FII selling at the end of December had reached to such negative, FII net outflow was the lowest we have seen in the last 15 years, other than maybe 2 months after ILNFS and maybe 1 month in Jan 2016. So other than those 3 months, we have to go around the GFC level to find this kind of selling by FIIs. So which also gives one point that, and unlike previous periods when rolling 6-month outflows would have meant rolling 6-month returns on Nifty also getting negative, that has not happened, which makes it quite, which makes me worried that I can't really take that opinion that it will bounce off from here, because typically what used to happen when FIs used to sell, Nifty also used to become more attractively priced versus its peers, which has not happened so far. So I would say that just blind liquidity will not help, because valuations do also come into the picture. And that's where I would bring the argument on the domestic side. See, what we need to appreciate is this kind of steep yield curve. We'll have to go back in 2008-9 when it was so steep. As tightening happens by RBI and rate, generally tightening of liquidity as well as rate hikes, perhaps near-term yields will also improve. As that improves, and now if you were to do a simple comparison of bond versus equity valuations by looking at earnings yield and bond yields, 10-year bond yields, we are at levels which has historically led to sub 5% return from Nifty. So clearly that is not in our favor. And so what is the worrisome environment is over the next few months, as near-term yields rise, and if we could see a few months of negative returns on the market, some of the domestic money could start shifting back to debt. A lot of it came because there was very little return to be made in near-term, 1 year, 2 year kind of debt investments. And that will change as liquidity tightens. And if near-term returns on equity markets isn't that great, then that money could start shifting out. Anyways, if I were to look at a simple chart of percentage holding of equity by Indian households, we have already hit all-time high levels higher than 2007. So we cannot take our eyes off that debt equity valuation thing. I think, and as that shifts, FII liquidity will be important for us to support the markets, even more so, because this could also be the year when, primary markets could be even more, busy with a lot of the lock-ins also coming out. We estimate that there could be a pretty big chunk of lock-ins which could come out, and they could be finding stakes. There could be more stake sales plus the normal primary IPOs as well. So FII money will be important, and maybe more so if this DII liquidity dries out, if debt yields improve in the near term as well.
Okay, Vikash, we let it end it over here. We've run out of time. Many thanks, as always, for joining us live. That's CLSA's insights for you on the market. A very timely interview given the global picture, how we're expecting rate hikes in the US, where crude is trading, and of course the treasury yields. And on top of that, we've had India outperforming the rest of the world, haven't we?